Welcome to the course on Master of Technical Analysis by Stock Market Files. Today we will discuss Doji Candlestick pattern. So Doji Candlestick pattern look like this. So if you look at all these types of dojis, they have no body at all. The body is very small compared to the range or wick of the doji. So the price closes where it opened. So the price in this particular case, the price opened here, it went down, then it was taken higher by the bulls, but finally it came here and closed where it opened. So the doji candlestick pattern represents the indecision between the buyers and the sellers. It also represents the tug of war between buyers and sellers, or the bulls and bears, where no one wins. There are these three types of doji patterns. The first type of doji pattern is the pattern where the wick is of equal size on both sides of the body. This represents the indecision among the buyers and seller. The second type of doji looks like this, where the upper shadow is very higher compared to the lower shadow, or there is almost very small lower shadow. So such kind of doji is called as Gravestone Doji. In Gravestone Doji, the price open, it was taken up higher by the bulls but could not sustain there, and it was brought back down by the bears and finally close here. So if we look at this pattern, we can see that the bears were more powerful compared to the bulls. So if such pattern represents the bearishness in the market, that means if such pattern occurs in the ongoing uptrend, we should either quit our long positions, or we should take a short selling position. So this Gravestone Doji is more powerful when it appears at the resistance level. So that gives us a potential trade opportunity. So next type of doji is called as Dragonfly Doji, where the lower shadow is much higher compared to the upper shadow. This doji, in this doji, the price opened here, it went down, it was taken down by the bears but could not sustain there, and it was taken up by the bulls and finally closed here. So in this doji we can see that the bulls were more powerful compared to the bears. So this represents a bullish candlestick, where the power of bulls was more compared to the power of bears. So if such candlestick pattern appears in the ongoing downtrend, we should be alert, and we should quit our short selling positions, or we can take the buying position. If such doji appears at the resistance, at the support level, it is more powerful. It indicates the potential reversal of the ongoing downtrend, and thus provides us an opportunity of trading higher or going long. So doji candlestick patterns are very effective in the longer time frame, maybe one daily time frame, weekly time frame, or monthly time frame. On smaller time frames, they are not much effective, particularly the time frame less than 60 minutes. They are more effective in the time frame greater than 60 minutes.